community of more than 20,000 foreign exchange traders. That's a lot. I think that's a ton. So with that being said, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. It's always wise to stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. My name is Wayne. I will be your guide on this journey we call Forex. Ooh, that's hot. That's hot. So let me know how I can help. Today I recommend we go over gold, oil, Bitcoin, silver if you want. We'll look at the stock market indices around the world. I'm sure you want to look at dollar pairs, maybe some cross pairs. I don't know. You're the boss. I'm a humble servant. Let me know how I can help. We can cover technical analysis, fundamental analysis, trader psychology, fundamentals, macro, whatever. Again, you're the boss. So this is your hour of power. We come here every day to sharpen our swords. My intent today, like every day, is I don't intend to throw you into a bunch of trades. Go, 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 trade, let's go. Scalp, look at me. I made 12 pips today. Instead, I want to teach you how to trade properly. Patience and discipline is probably what you're going to learn. I will show you technicals. I'll show you how to align them up. I'll show you how to take fundamentals, strategy, and tactics and put them all together. But I'm not going to dump you into a trade. I wouldn't belittle you like that. So anywho, think about ways that I can help you improve your trading skills. There are plenty of resources that I've created for you over the last 20 years of me doing this. Before that, I was a venture capitalist. That's interesting, huh? And then I became a trader. This is the first thing I ever traded. So anywho, let me know how I can help. If you look at the description below the video, there are resources made because people asked for them. Many, many, many years ago, people asked me to write a book, so I did. Published by Wiley Publishing. Cool. Made a bunch of training courses. Right now, there's about 88 hours of really hardcore training. To access those, you need a basic membership at FX Bootcamp, which is $88 a year. Yeah, the link is in the description below. And yes, the $88 a year gets you access to every single one of those training videos. And then lastly, in the description below, you'll see a link to tradersway.com. And I believe them to be a trustworthy, ethical foreign exchange broker. They earn my loyalty and respect. So if you value that, go check them out. See if they have fast execution speed, narrow spreads, huge swaps, all that kind of stuff. But ultimately, I trust them. If they can earn your loyalty and respect, maybe you'll open up a real account with them, huh? Best way to judge a small business is by the service providers they choose. It's sort of like judging somebody by their friends. Well, Traders Way are my friends. What is this? What? Something's changed. Oh, well, I'll have to go check that out. What is that? I guess maybe Traders Way changed their website. Hang on. Let me see why that is gobbledygook. They did. Interesting. Interesting, huh? All right. So I'm going to update the... That's nice and clean. Look at that. How do they know I drive a Porsche? How funny. One broker, several ECN platforms. Yeah. Cool. Ah! Gold! Very nice. La la la, la la la. Very nice. C Trader. Never actually traded with C Trader. I should try it. Cool. Mm-hmm. Cool. Interesting. See if they've... Nice. Isn't that nice? Oh. You blocked me. Anywho, shouldn't need that here, right? Oh, no. Anyways, very cool. So I need to update my little image here on the stream. Darko's installed C Trader and is testing it. Cool. I know it's pretty. Yeah. All right, so let's look at the currency indices and then we'll look at the stock indices, eh? Sound like a plan? All right. Pound coming down. Just these are short term, by the way. Saskatchewan. Rodell's in Saskatchewan. You're like, no, I'm in South Korea. Oh, okay. South Korea or Saskatchewan? So anyways, pound coming down. Remember, these are short-term indices. We can take a look at the longer ones, but we are looking for pound weakness this time of year. Dunburn. Cool. Actually, I don't know where that is in Saskatchewan. I'll have to look that up. Whereabouts is it? Dundurn. Probably south, I would guess, huh? I grew up in Toontown, so I don't know southern Saskatchewan that well. But if it has a hockey team, I know of it, if it's in the Western Hockey League. So anywho, check this out. Aussie strong, maybe a reopening play. Euro turning. Okay, Kiwi all over the place, dollar all over the place. Yeah, whoa. So it's just very all over the place. But the big thing is euro and pound turning, which is kind of interesting. Pound we expect, euro we've been waiting. So let me look at the longer term indices. Rodell, what other city are you closer to? I guess I can just Google it. 20 minutes from Toontown going south. Huh, so interesting. Man, that must be a small town. Hang on, I just got pinged. No, there we go. Interesting. Dundurn. Let me Google it. Oh, yeah. Town in Saskatchewan. Yeah. Oh, very cool, dude. Yeah. Downtown, huh? Where are you? Pretty. Yeah, I grew up in a place like that. Yeah, there. How old are you? Are you young? Old? Somewhere between. You're like, how dare you ask me that? I remember being in a town like yours at very young age, probably, yeah, you're 45. I must have been 16, 17. Pretty young. Maybe was I 18? No, I don't think I was 18. Anyways, I remember being in a small town like this. And I said to myself, I got to get out of this town. I got to get out of here. And oh my God, what an amazing trip it was to get out. And right. So the story I like to tell, even just to myself as a reminder, I went from a town like yours, standing on a corner, probably at that gas station at the end of the street. And within 5 years, I'm on the board of directors of a nonprofit organization at a board meeting in New York City. I'm wearing my first suit. I'm on Wall and Broad Street. Fancy, powerful law firm, top of the skyscraper. And at that time, I was managing about 3,000 people. And I started on one of these sidewalks right there, and I just started walking. And all of that in 5 years. I don't know how I did it, but I did it. And it's really remarkable. So it's great to see. Oh, yeah. See, I would have learned how to ski on that. Actually, I might have. Oh, that is Blackstrap. I learned how to ski on that mountain. Oh, my God. That's cool, dude. Are you close to Blackstrap? Abandoned ski lift. It's abandoned. Wow. I learned how to ski on that mountain. Anywho, hey, thanks for sharing. A little trip back into the world. But one of those things, what it taught me is anything can be done. Anything can be done. Is what I learned. Okay, looking at the longer term indices, yen is still trending up and US dollar is still trending down. So nothing has changed, huh? Swissy all over the place. But Aussie really making a recovery play. So this might be your China reopening play, which we talked about maybe 2 or 3 or maybe even 4 swing trade groups. No, I think it was 2. 2 swing trading meetings ago. We talked about the possibility of using Aussie. Or was it this one? Maybe it was just this one. Yeah, it was this one, right? I said you got 2 choices. You can play the China reopening strategy, or you could do a stock market recession strategy, U.S. recession strategy, China reopening strategy, or U.S. recession strategy. Yeah, that was just the last one. Yeah. Quite a few good discussions out of that. That was really cool. Again, it was 4.5 hours. But holy smokes, what good conversations, right? So anyways, I look at this and I'm like, yeah, that's probably the China reopening play. You can see here, Kiwi has been giving some back, but maybe it's just a little role reversal. Remember, this isn't the New Zealand US dollar, as it says up here. This is New Zealand versus everything. So that's kind of cool if it pops and turns. Now, remember, one way you could use this is you could replicate the strategy and just have a basket of, you could be long Aussie dollar, long Aussie Swiss, long Aussie yen, long Aussie CAD, long Aussie euro, or whatever, and build your own indice. Or you could build a basket and say, well, if you can get like Aussie Swiss franc, Aussie euro, you might be able to earn a carry on some of these things, right? So look, you could see, let me say this differently. You could look at the Aussie dollar index, and this is the longer term one. And then you could zip over to, to this chart and short pound Aussie, short or long Aussie Kiwi, long Aussie CAD, long Aussie dollar, long Aussie yen. And that's how you'd build that. Okay. Then you can say, well, maybe you're not going to do Aussie CAD because you're also bullish on, Aussie Kiwi, because you're also bullish on Aussie Kiwi. You could do that as well. Okay. Okay. And it looks like I have it set up for you anyways. So, nice. Looks like we did this somewhere, day trading group or swing trading group. Nice. Golden. Dang, that DJ made my day. So Rodell's from the Blackstrap area of Saskatchewan. Yeah, very cool, man. There's a nice lake there, too. Okay. You can see this is an interesting technical low. Okay. You see how I connect all the, right? They're actually called fractals, but you can see how you connect these bottoms. I would probably connect these bottoms in here like I've already done a year ago. So down and then up and then maybe down again. So Darko, you would rather switch trading platforms than switch telephones, huh? You're like, I have an iPhone and I can't use MT4. Get a different phone. Have two phones. One for trading. I mean, the other phone, the Android phone doesn't even have to have cellular service. You don't even need a SIM card. You just use it on your Wi-Fi. Use Wi-Fi. Upgrade to Android. Well, I remember when I worked at Apple, we used to have these stickers on our car. It said, it had the Apple logo and it said 1985. And then it had the Windows logo and it said 1995. And 84. So Apple, right? Apple 1984, Windows 1995. Because Windows 95 was just a ripoff of Apple. Yeah. Well, whatever, right? Whatever. All right. So that's how you use these longer term indices. Isn't that nice? What do I expect for what? Rephrase your question, Hamza, and I'm happy to dive in. Okay. So again, what we talked about a week ago is planning trades around a China reopening theme and focusing on buying Aussie dollar. Okay. So that's sort of like an expectation. So we focused at the last swing trading group on thematic investing. So again, rephrase your question and I'll happy to address it. But the other thing is, if you're not a member of the swing trading group, you should join the swing trading group. Because if I didn't express an opinion on direction, I assume you already know. But if you don't know, then you should ask, because again, I forget these things. Coolio. So let's get off of that and let's go to the stock indices. And then we'll do commodities. Boom, 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 boom. All right. S&P 500. One of the things we've been talking about lately, what you talking about, Willis? Let me get Epic. What we've been talking about lately is, first of all, trying to find a change in direction, and we're maybe working our way there. Okay. The second thing is the Microsoft earnings, which happened on this channel. And one of the things we've talked about over the last couple of days is, with Microsoft laying people off, 10,000 people, are they going to report good things or bad things? Like, what's our guess on their outlook for future business if we are going into a recession? And do they think we're going to go into a recession? So what we found out is growth in their cloud business is good, but it's going to slow. It's not going to be terrible, but it's going to slow. So that tells you the businesses are probably not investing in moving to the cloud. They also expect like their subscription business for Microsoft Office and Windows and all that is going to slow because businesses don't want to hire more people. They want to have less workers, so they don't need as many subscriptions. Nor are they buying new machines, so you need Windows, whatever the hell we're on now. It still doesn't work. After 30 years of building Windows, it still sucks. But whatever. Microsoft's like, you know what? The future's not that bright. Cool. Well, that's what I was hoping for. And so now maybe we're slowly turning the ship around. The analogy we talked about in the day trading group the other night was turning around a cruise ship at port. Okay, it's not going to be quick or easy, but there's a plausibility of it happening. Now, I'm short here, not doing very particularly well, but I anticipated a move just like this last week, and I got it. So I thought that was the move. You see what I mean? So what I thought we had was, so I sold a lower high at a daily pivot, at sort of a weekly, and well, it didn't work out. So now I'm hoping we kind of work our way back around, and I think if anything, it might sort of take a while. It might do like a head and shoulders type thing. You know, we got some vol ahead, I think. So, yeah, I'm not in at a particularly good price, but we'll see. And it makes sense that this is this is the turn on Microsoft news and earnings season. We talked about even in January that earnings season was going to be a big part of our trading theme in the first quarter, particularly in third week of January. Okay. Don Pablo says, hey, I think the market will slow as we wait for the Fed meeting. Well, yes and no. So we have like Tesla reporting and IBM reporting and a few others, well, actually quite a few others today. And between now and the Fed meeting, I think people might learn that they could be wrong in their positioning for the Fed meeting. And for that, we look at the Fed funds futures market, and we see that a Fed pivot is almost certainly priced in. But I'm still, even though, I'm probably the one wrong. 99% of the market or something like that thinks the Fed's only going to raise by 25 basis points. And what that tells me is they're only looking at the headline inflation numbers. And there's a big bet that we're going to have like, a soft landing, and the Fed's going to, literally what's being priced in is a 25 basis point rate hike in February. In March, they're not going to raise at all. And maybe I'm stupid. Maybe I'm arrogant. Maybe I'm just ugly. But I don't understand why that's what they think. Because I do listen to the Fed. I do the deeper research than headline numbers. And I think they're going to raise higher. I think the market's wrong. That's why I'm like, maybe I'm arrogant. How could 99% of professionals be positioned for a Fed pivot, and I think they're wrong? So here's the thing. Don Pablo says the market will slow before the Fed meeting. Yeah, if they're already positioned, right? But what if we get a slew of sort of negatively viewed earnings? The market might say, oh my God, right? And maybe we go from 99 down to like 80%. And that would be enough to maybe bring a little bit of dollar strength, bring the stock market down a little bit. We got to get people nervous that they might be wrong. And of course, what I need, and this is the troublesome part, is I need 99% of the market to be wrong. And the Fed raises by 50 basis points, and that'll bring a lot of dollar strength. If they pivot, then I'm the one that's wrong, and I need to adjust. And the biggest thing that you could take away from that is seeing me do all the research and getting my interpretation wrong compared to what the market is done, and how to not lose a ton of money when you're wrong. That's not the lesson I planned on giving you, but it is a lesson nonetheless. Okay, so, well, that happens. Imagine your next 20 years of trading. How often do you think you'll be, let's say, just wrong or off? Well, likelihood, often. So the secret is when you're off, how do you behave? Is it in such a way that you'll survive? Okay. David says the daily chart is reflecting the confusion you're saying too, Wayne. What, on the stock market? It says consolidation. Yeah. Yeah. To me, and confusion, I think, David, is maybe too strong of a word, and it makes sense. Like, I'm not judging your word choice, but it's more like how I'm trying to share, like, how do I think about the market? It's right. That's part of training. And I think the market is just positioning. Okay. And we probably don't have all our market participants. Maybe that's why it shows of the market participants, 99% think this is going to rally and we've hit a bottom and we're going to go to 5,000 next. I just don't believe that. But maybe of those that are participating, those are what they believe and that they've positioned properly. Now, the flip side of that is, there might be a boatload of bears waiting for their turn, right? And so who knows? But if we're going to look at technical analysis, we look at this right here. And that is the proper price, technically, for a bull to buy. That's actually where a bull should buy. And they did buy. Okay. The next thing I see is this is the price in which a bear should sell. And we haven't really breached it that much. We popped up there for a week, this week, and spent one day above, but that created a spinning top, and now we have a bearish engulfing candle. That I think is called an evening star, isn't it? An evening star reversal pattern. So what might happen next is that we come down to the daily 21, and then it comes up, and then we come down to the daily 55, and then we come back up, and then we have a play this way. And that's how a bear would think about it. You know what I mean? So judging what's happened, it makes actual sense. Oops. Okay, this makes sense. And what it's telling me is nobody's wrong. People are just positioning. Okay, you have to think about proper trading and investing, especially outside of a 15-minute chart, right? You have to understand that bigger institutional investors said, if we are going to buy the stock market, it's going to be at 3,800. That's what the technical analysis says. And some people might have taken part of their portfolio and bought it just in case. Or maybe that's just when they need to deploy their capital. The last day of the year or the first day of the year. Okay? Last week of the year, first week of the year. Is just maybe for some the right price to buy. Doesn't mean it's a bullish trend. That's just the right price. Okay? And then on the flip side of that, they also had up at this price, 4,000-ish. Now, mine is 3,994 or something, but whatever. Okay? And this is just where bulls buy. And this is where bears sell. And nothing else has actually been declared. See, we're retail traders, so we love to read into all of this. We love to read into all of this. Oh my God, this means this and that means that, and these guys are doing this, and they're hunting our stops, and these are clearing the market, and all this kind of stuff. And I'm like, oh my God. Settle down. Bigger institutional investors just say, this is the buying price, that's the selling price, and the rest is waiting. Oh, Hamza says, I didn't like my question, so here's another. Okay, well, I missed your other one? Sorry, man. The markets think we're in a recovery phase. So where do you think we're in an economic cycle? We're in demand destruction. Okay, the cost of money is going up. Okay, some levels of inflation are coming down. Companies are laying off. Job openings are falling. Unemployment is almost certainly likely to rise. Okay, so we're in a contraction part of the cycle. So, to be more specific, we could do it this way where we say, all right, template, blank. Okay. As you probably know, the United States GDP grows on average 2.2% over the last 50 years. And okay, that's the average growth. But then we have periods of contraction, expansion, contraction, expansion, and contraction. Okay, this is also GDP. Okay, so the pink line is potential GDP, and the blue line is actual GDP. Okay, so after what COVID did was it dropped us like a ton of bricks into a scenario where the stock market dropped and everything else dropped. Okay. And what happened is people lost their jobs or started working from home and were not very effective and all this kind of stuff. But what we have is something called a productivity gap. Then we got stimulus from the central bank and the central government. And we created a big rally. We filled the productivity gap. And we went into this expansion phase to the point where we had shortages of everything because we gobbled up all inventory when factories were still closed. Okay? Which created rampant inflation. And we burned through our stimulus, spending it on strippers and booze and cigarettes. And I'm not even joking. The vast majority of stimulus checks that were spent on food and beverages. Anyways, so we get to this point where we have high inflation. Okay? And now the Fed is doing the opposite of stimulus. The central government's doing nothing, but the Fed is doing the opposite. And they're trying to contract the economy. And we're just starting to see job loss. So where are we now? We're in this phase where we used to have a productivity gap. I guess we could call this demand destruction. There's another term for it, but we'll leave it at that. And that we are coming back down toward potential GDP. I mean, GDP skyrocketed in this period, like it was super ridiculously high. What was it, 8% or something? And so we filled the productivity gap and then way overshot. Okay? So anyway, so we're in this contraction period now, in my humble opinion. And we're still well above potential GDP. So when we cross below potential GDP, when actual GDP crosses below potential GDP, that's when we're in recession, and we're not there yet. Okay? So what I predicted in my annual outlook was, and I didn't explain it this way, but for those that have done it, this is the first half of the year. This is the second half of the year. How long will this last? Let's say a recessionary period? Well, it depends on how you define that, economically or in the market. But again, I'll answer that and then I need to move on because I did do a 2-hour presentation. How long will it last? Probably years. Okay, probably years. 3, 4, 5 years of mediocrity. Cool. So anyways, looking around the world, remember, one of the things I'm trying to wait before I do a bunch of trades is I'm trying to see this head down, this head down, this head down, this head down, this head down. And I don't think this is going to go down. I think this is going up because that central bank is doing the opposite of all these other central banks. Oh, my pleasure. They're great questions. Okay. Have you joined FX Bootcamp? Sometimes we have different names over there, so than our YouTube names. Okay, good. Right on, man. Okay, so anyways, that's the difference now. In my opinion, this is the result of central banking policy in these economies. Now, we've had 3 or 4 or 5 or 6 weeks of up, but dude, there's a lot of there's a lot of time over the course of a year, you know? And I would say, like, think of these as like trade winds. You're at sea on a sailboat. You need to know when the wind is likely to blow and what direction it's likely to blow. It's just important, okay? And the way I read the central banking policies of these different economies, right? Well, this is US and this is US, but this is the UK, this is Germany, this is Europe in general, right? And then this is China. And I would expect up. I own Chinese stocks. Not TikTok. But I figured if I start doing TikTok dances, right? I'll start getting big views, big views. But I don't invest into TikTok. So anyways, so the thing is, I've been expecting down, 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 up. But what I've been getting for the last few weeks or, several weeks is up, 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 up. All right, well, I better not sell in an up market. Okay? And so I'm looking for evidence of a change of direction so then I can engage the enemy on my terms. Imagine, guys, imagine a scenario where you only traded markets in which the technical analysis confirms that you're right. Okay? Imagine you only trade in those scenarios. Okay? And you traded the same number of trades. So let's say you make 1,000 trades a year. And right now you trade your 1,000 trades, the same number of trades every day, whether it's bullish or bearish or bullish. You don't really know. You don't really care. And you do 1,000 trades a year. And at the end of the year, it's probably mediocre. It's okay. That's why we're all here. Now, what if you still did the 1,000 trades, but you only sold in bearish markets and you only bought in bullish markets. So let's say you traded half as many days, but the same number of trades. Would you do better? And I think we'd all say, well, yes. And then I say, well, why don't you do that? Okay. Positive EV is the key. What's the EV? Sorry. Oh, expected value. Yeah, I suppose. I don't know if I 100% follow. Maybe explain a little bit more. You're onto something. It's not quite clicking with me. I know I get the gist, but yeah, tell me more. Yeah, tell me about positive. If positive expected value is the key, then I want to know more. Okay, great. Expand on that so I understand, because if it's the key, I want to know, man. Because look, like for those that trade both ways, like a broken gate, long and short every day, they're making those trades because they do expect to make money. So yeah, maybe expand on that. What would give you a better expected value? Okay. But what you've been watching me say day after day after day now is that, I'm waiting for a change in trend, right? And we may have that now. So the theory is I can engage. Okay. How about this one? No, not yet. No, not yet. Careful. Now, I do expect this one to fall more than the S&P 500. But it doesn't have to go first, right? Just be careful. How about this one? Yeah. See the difference? Lower high versus NASDAQ, which is kicked off a higher high. There's a big difference between what we have here, which is, okay. So what I talked about, and it might have even just been yesterday in the day trading group, 4 p.m. yesterday, I said, look, I'm a bear, but I can't sell it. But the one thing we know to be 100% factual is you cannot buy it. And even if you're a bull, I said in this example, if you capitulated and said, you know what? I think I'm wrong. I've done all my research and this is supposed to go down, but now it's just clearly not going to go down. So now I want to change teams from bears to bulls. I said, even in that situation, what we know is you cannot sell it. I mean, you cannot buy it. You can't buy it. Even if you are now a bull for whatever reason, you still can't buy it. If you're a bull, you still need it to drop to this price. And I highlighted this price. And I'm like, even if you're a bull, you got to wait for the drop. And if you're a bear, well, you expect the drop. But I'm like, well, you could sell it. It's a little bit risky, but maybe you sell the next one kind of thing, right? Yeah. Okay. Cool, Patrick. Over a series of trades, winners and losers, if there's a positive expected value, then that means one can lose it. Yeah. And I suppose, Patrick, that it should be a common, how you say in English. In the back of somebody's mind, they think that they're doing that. But then when you look at the math, they're not doing what they say. So I guess this is one way to piggyback on your comment. If you look at your average loss, okay, average loss. So you go your average loser, And let's say it's negative 33 pips. And then you look at your average winner, and it's 99 pips. But 66% of your trades are losers, and 33% of your trades are winners. How much money do you lose with 66% losers? What's your profit and loss on this? Anybody want to guess? It goes right toward Patrick's comment, and it's a great comment. Anybody? Bueller? 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 How about this? Type in a question mark. Let me know that you're thinking about it, or you don't know, or let me know you're listening. Thank you, Rodell. Thank you, Roderick. Yeah. Yeah, I'm waiting. Yeah, I need you to type into the keyboard. See, the reason I ask you to respond is because this is a key concept that amateur traders just don't get. And by me forcing you to actually type it, you have to think about it. You have to type it, which means you have to translate your thought into language and then your language into typing. You have to go through an emotional thing of like, what if you put in the wrong answer and I laugh at you in front of all these people? You get public humiliation, right? What's Don Pablo going to think about me if I type in the wrong answer? Well, really, what do you care? Right, Don Pablo? Like, you don't know each other. You're not neighbors. You're like, you can't even see each other, right? So like, but I still need you to answer. And the thing is, when you go through the emotional and the intellectual, and then even the language idea of typing it, you end up potentially remembering. You forget 99% of your life. So if I can find a way for you to remember key points, you might potentially actually grow. So the answer I'm looking for is break even. And what Patrick is getting to is if the trading that you're doing, whether it's the type of setup or how long you let your winners run or how small you let your losers be or your winning percentage, the math needs to work. So if you're a trader that gets 50% wins, half your trades are losers, and half are winners. Do you understand? Because your trades are good trades. You are a profitable trader, and half your trades are wrong. Okay? And this is a point that I try to make a lot. If you're in the game of trying to do 25 pip winners and 25 pip losers, or even, God forbid, 12 pip losers and 12 pip winners, I don't think you will ever find success ever. Ever. I think your expected value is negative 100%. Because for this to be successful, you got to be gol darn near 100% on these trades. And to make any serious money without over risking, you're going to need to make 10,000 trades a year and work 8 hours a day to get those types of trades and be about 80% correct, let's say, or 75-25. Okay, 75 winner, right? And 25, right? And statistically, I just don't think you're going to do it. And if you do it for 1 year, I'll high five you. But you're not going to be able to do it for 20. It's just incredibly hard work. And you have to be amazingly good for very, very long periods per day, every day, for decades. And going back to what Patrick was saying, dude, it just doesn't make sense. Okay. Now, Richard says that's why technical analysis is key, because it's all about risk management. Well, it's partially. Okay. But I would say it's not all about that. It's important for sure. But I think the big distinction between a career and a hobby is that you got your fundamentals right. Okay? That you're able to do this. Okay? And for some, if I said your average winner should be 99 pips, a lot of amateur traders, they find that unbelievable. 100 pips is a lot. Okay. That might be the issue. And then when people join to me, that's a day trade, right? And this is what we go for in the day trading group. When you join the swing trading group, we start talking about 333. Okay. And you might, if you don't have a lot of time and you can't make thousands of trades per year, what I recommend is you start looking at a 9933 type setup where you spend your, let's say 1 hour per week swing trading. If you only have 1 or 2 hours a week, you can have a trading career. And I wouldn't be shocked if you did better than most day traders. Because day traders are so focused, because I see when people join FX Bootcamp, I have to turn them around, but they're going for 13.23 or something, right? And we turn this around and look, if you don't have a lot of time, let's say you have a side gig, you actually have a job, a job, okay? Weekly swings are probably the right way for you to go. And now the next step in your career is being able to do both. So risk management is good as a start, because in the beginning, a new trader, they lose a lot. So we need to focus on stopping the bleeding. But after that, your next phase of a trader is you're really good at risk management, but what you need to learn is how to let your winners run. And after maybe a few years of that type of learning experience, you'll find that your losses are small and your winners are good, And then you're just focused more like on seasonality and changes in central banking policy and the impact on the psychology of the market. You're working on that kind of stuff. But technicals are pretty straightforward. Okay? And then you got to get to that whole trader psychology thing where your analysis says down, the market's going up, and you just wait. And if you don't trade very much for 3 or 4 weeks, so be it. It's not your fault. Those are just the market conditions, and you're waiting for the conditions to change. And when they change, you have more opportunities, and you trade under market conditions that you've chosen. And all of a sudden, your losers are small and your winners are big. And you might have 60% winners and 40% losers, and you're very, very, very profitable. You see? And the other interesting thing is if you can keep your powder dry in market conditions that you didn't expect, which means not on your terms, and instead only trade on your terms, meaning you predict a bearish market, so you wait for a bearish market. When the bearish market arrives, then you technically start selling lower highs, right? All of a sudden, what happens is in periods of, let's say, consolidation and choppiness and volatility, you have low volatility. You see? When volatility is high, you're not trading. When market's consolidating, you're not trading. And then when the market trends, you're trading. So at the end of the year, when you do statistical analysis of your portfolio, you find you have low volatility and consistent returns, which gives you a good Sharpe ratio. And so even if a fund manager makes more money than your fund, your competitor, an astute investor will look at you and say, well, you're much more consistent with much lower volatility and much better risk-adjusted returns. So you might have an absolute return of less, but you're a better, smarter, wiser fund. And an astute investor would choose you. So you turn $1 million into to 1.1 million, and some other another portfolio manager turns $1 million into 1.3 million, but your 100,000 was the smoothest, most consistent, and what the investor thinks about the other portfolio manager is statistically, it was difficult statistically to calculate whether that other fund would end the year at 1.3, 1.2, 1.1, 1.0, 900. Like statistically, you might find in 3 months that 1.3 is back down to 1.1, where yours at 1.1 has grown to 1.1 and a half. Because you're just slow and steady and have very low volatility. And astute investors will always pick the slow and steady, the tortoise, not the hare. Because it's about calculating risk. They want to know consistency. The only time someone will give you $1 million and say, I want high returns, is when the $1 million is chump change. So that means you're talking to somebody with $300 million or more, 400 million, 500 million, and that's doubtful. It's just really doubtful. Someone's like, play with this $1 million and see what you can do. Turn that into 3 million and I'll be happy. That's just not how the world works. Now, I have had that asked of me, but there's usually nefarious rationale behind it, and you got to be very careful when somebody says that to you. They either have no idea what they're talking about, or there's some bad reason behind it. And also, you got to be careful. That's the kind of investor that they ask you to turn 1 million into 3 million as fast as possible. And then you try to do it and you lose the million. And then what happens? Something very bad is probably going to happen to you and your family. So be careful who you take money from. So when somebody says that to me, I'm like, no, thank you. Because it doesn't make any sense. Remind yourself, anytime you get pitched a get-rich-quick scheme, or you're asked to, as a professional money manager, to get somebody else rich quick. There is no get-rich-quick. Ever, anywhere, under any circumstance. It's fool's gold. It's a mirage. It's a siren singing a song that pulls you into the rocky shore. Run, flee. Wash your hands clean of that. Whether it's you or somebody else. Okay? All right. So let's go and do some commodities, huh? What do you want, gold, oil, or Bitcoin? Okay. Gold, oil, or Bitcoin? Well, we can start with silver. Yeah, okay, Pete. Yeah, I think I forgot to do that yesterday. Ask me again if I forget. So now we have a range inside of a range. We had a false breakout. I traded this and lost money. It's 786 on me, and now we're stuck back in the range. So it was a fake out. So slow and steady, steady and slow. Silver just stuck, not really good thing to highlight. I'll get rid of this. I'll move it. We kicked off that EMA yesterday. Okay. So I think we're caught between the EMA and the trend line. Yeah, but it's timing, right, Richard? So I waited. And what I teach you is that if you're going to sell it off the top, or wait for the breakout, and it broke out, and sell the retracement. And that's where I sold. I sold the 3A2. But it went from 3A2 to 50% to 618 to 786. And I'm like, get me out. Out. Okay. And yeah, now we're just... Okay, so the next thing I teach is if you're in a range, it's going to stay in a range forever. I thought we broke out of the range, but I guess we just expanded the range, if you will, and we just dropped into a range that now looks like this. And I guess I can combine that. And okay, so too bad, so sad, maybe, you know. So maybe the range looks like this now. Okay, well, take a walk. Okay. Yeah, so Patrick, I don't reckon I'm a macroeconomic trend trader. I've never told somebody that I'm a range trader.